And we'll go take a look at OptionOmega. Let's see. We're looking at the SPX year to date, a long put spread, because I mean we've been down all year. No reason to test long calls with this. Just getting in the mornings, running it every day. No more than 2% of the account in a 10,000. How many zeros we got there? 100,000. Let's knock that account down a little bit. $100,000 account. So a $10,000 account. No minimum or maximum on how many trades are open. 30% target. No stops. Commissions, I put $3 in total in there just to because when you trade SPX, the commissions are higher than a regular options trade. And then we will ignore anything that has a really wide bid ask, which it shouldn't because it's so deep in the money, but still it's possible. And then we want to get at least 2 hits on the premium shown for taking profit. And I added the blackout days from some of our previous streams. These are pretty much holidays, short weeks, FOMC days. We wouldn't trade that stuff, right? We would avoid trades on things like that. I picked a 60 and a 62 delta, so I'm not too far in the money, but it is something that we could consider adjusting. All right, so for some of you newer options traders who maybe see this and aren't quite grasping what we're doing here, I think it might be easier if we go over to the options chain. So we're looking at the SPX. Seven days from expiration. We're on the put side. And we're running between a 60, what did I say? A 60 and a 62. So we're in the money, kind of sitting way down here. And we're putting on a long put spread, which is another way of saying a debit spread, that we are buying puts and we're going to hold for a 30% profit as a first test. We might adjust that and see how much better we can get. So let's just give it a little test drive and see what we get. All right, well, it didn't like that. So let's see what I got going on here. I think maybe the size of the account. Let's check the trade log and see how much these things are. Yeah, that's weird. All right, let's go in there and see what's going on here. Let's add a 0, make that account a little bit bigger. Otherwise, we're going to have to swap over to maybe the SPY or something. All right, so that did it. The account was too small. And when you're running the back tester, the SPX is a big product. So, if you get an error like that, one of the first things you want to check is the size of the account appropriate for the kind of trade that you're putting on? If it's just too small, you're going to get those kind of errors. So I made the adjustment, and for just this year, all the way up to July 11, this found us 115 trades. And out of those 115 trades, we won 97 of them. And the account would have grown after the losses. It would have grown about 36,000. Let's see what's going on in here and what we might do to make it a little bit better. Now, when you're trading a deep in the money option like what we're focused on here, it really is like a synthetic stock, right? And then it would be much better to spend perhaps $275 to control pretend 100 shares than it would be to go out and buy 100 shares. Now, one thing that a lot of newer options traders don't quite grasp is that the delta value is a reflection of your pretend stock. So in this situation, we're really not looking at 100 shares. We're looking at around 60 something shares because we're trading with a 60 delta. The max winner and the max loser gets my attention here. Obviously, we're going with like a 30 something profit. And so with no stop, if we happen to lose, it's a 70% kick in the face, right? So one of the things that we would want to adjust first is, hey, what can we do with this profit? Now, I don't like stops. I just don't. When it comes to options trades, I hate them. I would much rather put on some kind of alert that notifies me that, hey, your trade isn't working. What do you want to do with it? And then I can go in and make an informed decision about it. But just having a stop on there, options values will change for a lot of different reasons. And if the underlying stock, I mean, it doesn't even have to move. Just the Greeks alone can spike your options values into your stop and kick you out of a good trade. So if we leave that aside and just leave that stop off of there, at the very least, one of the things that we could do is try to adjust this target profit, try to make it maybe a little more fair to where if we win, we're going to get 50%. And if we lose, we're going to get a 50%. Okay, so that knocked our winners down even more. But even though it reduced our winners, I really want to point out that we made more money, that we kept more money. Let's say it that way. We definitely made more, but we kept more of our winnings, right? And this kind of goes back to the argument, not even an argument, but more of a nerd discussion about it's not the wins, right? The wins aren't the whole story. And I see a lot of traders that focus on a high win rate. That high win rate is out of your control. And the better your risk to reward, the lower your win rate. They're like an inverse proportioned product, right? So when you're trying to do good and trade with a really great risk to reward, you're instinctively, automatically going to get lower wins or a lower win percentage. And that's not necessarily a bad thing. So in this situation, we actually ended up with 42,000 in profit. And in the other one, it was less than 40. Okay? And sure, I mean, you know, there was losses, more losses now than before, but we got the difference between the max loss and the max win. We got that number reduced significantly. All right. Or I should say we increased the win side significantly. That's a good way to say it. So let's push the limits. Let's go back in and see what else we can do. One thing that I'm keeping track of, oh, I don't want to do that. One thing that I'm keeping track of is days in trade. We've got this set for 7 days to expiration. I don't want to be in things the whole darn time, right? I want to get the heck out. So the sooner the better. I want to get out of these things. And so I like to keep my eye on that. It also kind of helps us decide where that profit target. Are we too high, too low? What are we doing? Right. So the time in trade isn't too bad. We're not even remotely close to, you know, that 7 days. So I'd say we go back in and try to push the limits here a little bit more, 65%. Okay, now that made significant progress on our trade. Now we're looking at 75,000 for the year. The winners seem to be a little bit lower on the total number of winners, but the max loser is at least twice as small as the max winner. Even though the average loser is still pushing us higher than the average winner, at least that max drawdown is no longer so crippling as it was. The days in trade, we're staying in it a little bit longer now, getting closer to that 7 days to expiration. But this is looking like a really good trade strategy. Now, I've been trying to stress with people the idea that these are these are back tests, right? This isn't promising you that you can go out and trade exactly like this and that you're going to just, win all the time and make all this money. What we want to use this for is kind of first back test an idea, reasons to get in, what kind of strikes we want to use, what kind of days to expiration, profit targets. We find a lot of the answers to that here. But real world traders, I mean, we want to adjust trades and, maybe roll them and convert them into something else. We want to do more with them than just open them and close them. But this gets us pointed in the right direction. Do we want to use more days, less days? Can we push the profit targets higher and lower? It helps you define the criteria that you would want for a strategy and narrow down these parts and pieces. But as time goes by, you have to keep coming back to the table and checking and seeing if you should be doing something else. For an example, the way that we traded before COVID and then the way that we traded after COVID was completely different. And we had to basically shelf all of our original systems and come up with something different. As time goes by, whatever you're doing isn't going to work anymore, and you're going to have to do something else. So there's a time to be premium traders. There's a time to, be on the sell side more than the buy. And there's a time to diversify your portfolio more, maybe into things like commodities and bonds and, things other than tech. And then the duration of our trades, right? So learning how to do this, to be able to kick the tires of a strategy and kind of ask, hey, are you even still doing what you're supposed to be doing? Or should I make some adjustments and do it better? We want to focus on that. So we hit it to 65. Let's push it a little more, see what we can get out of 75%. I think if we push it too far, it would show up. I think we're going to start to see actual destruction of a strategy that was working really good. So far, we haven't seen that, right? We're dropping off a few more winners. So our win rate is getting a little lower, but our ending capital, how much money we made for the trades that we took, is continuing to get higher and higher. And one thing that I really like about what I'm seeing here is the number between these two is getting smaller. And what that's showing us is even though our total number of winners may still be going down, the amount of money that we're losing when we do lose is also going down, right? Because earlier we were seeing a pretty significant distance between how much the trades had made in total and then how much we actually got to keep after we took our losses out of it. And so I'm glad to see that this number is getting smaller. At least it seems like it's getting smaller, right? Maybe it's just wishful thinking on my part. So this is 75% profit. Our max losers are still under 4K and our max wins are above 8. So we're looking at a 2-to-1 risk to reward ratio on the maximum end. And between the average win and the average loss, well, the average loser is still bigger. And let's push the tires a little bit more. Yeah. Take it up to say 85%. All right, so our time in trade is now past 5 days and we started to turn the corner. We're now not making as much as we were in the last one. So we've gone too far. Aiming for 85% profit started to wreck this strategy. So we want to dial it back. Now in the real world, when it comes to something like 75 versus 85, what I have found most of the time is it's more like 69 to 79, something like that. We might aim for 75, but I can tell you from experience, I might want 75 and then we get too close to a holiday weekend or maybe CPI numbers are coming out and I'm like, well, I might as well just take my profit. I'm at 69%. I'm going to close it here. Right. So I might have wanted 75%, but a lot of times I don't actually get that. It's more of a window with a, say, a $5 or $6 range of percentage on each side. So again, just a representation that these back tests, they're good to kind of offer us a picture of what's going on, but we still have to approach it from a perspective of what a real world conditions would be. So I backed it off to 75%. We're still looking at about 185 ending capital, which would put us at like 85,000 on the year, starting out with a $100,000 account. And the reason for the trade was nothing more than like, well, it's 9:45 in the morning, time to go put my trade on. What we didn't test here is we didn't test any reason for the trade. Now, this is something that I always hear about from other traders. When should I put this trade on? Is this, a breakout trade? Did price fall down and bounce off of a trend line? Why are we getting in? And this platform will do that. It's got moving averages and that kind of stuff, but it doesn't have the kind of things that I would normally focus on, like a trend line, an institutional pivot point, or a universal pivot point. It just doesn't have those things. It doesn't have expected move built in. So I can't really give it the criteria that I would use to trade. And that's fine, because one of the things that I can use this for is just to be able to ask questions like, is it appropriate to build the trade in the money on the buy side with 7 days to expiration? And what kind of outcome could I expect? Now, obviously, if you was to be more patient and only put this trade on when you deemed it was appropriate to put it on, you would have obviously a lot less trades, but you also could very likely have less losses and keep more of your wins, right? So it's not like you have to go out and just do exactly what this strategy says to do. And a lot of the discussions I have with people, they're really unsure about what strikes they should use and what expiration they should use and how long they should stay in the trade and at what point should they take profit. Those are the most common basic questions that I get all the time. Should I use 5 days to expiration or 7 days to expiration? What about the 10-day? The 10-day looks pretty good. Should I use that? 3 strikes in the money, 3 out of the money, maybe 1 leg in and 1 leg out. What do you think I should do? Well, the really cool thing is you can use something like this and you can start seeking those answers out for yourself. By the way, all of those choices, there's a time to do all of those. There is a time to be completely out of the money or completely in the money or have 1 leg in and 1 leg out. And a lot of times it has nothing more to do than you and your risk tolerance. How risky do you feel, or how confident are you in the trade that you're about to take? So this is a reasonably decent long put vertical spread, and it makes sense because we're in a bear market, right? If we were in, say, last year's market, this trade strategy would not work at all. We would just be ripped apart. We would probably want to test it on the call side. And if you think about the kind of market we've had in the last few days, this graph really kind of highlights where the strategy started to have issues. Towards the middle to late part of May, into June, and now into July. I mean, sure, there was a few winners in there, but not very many. And we were either running sideways or we were losing money. So this strategy, just the way that we've been testing it, it is a bearish strategy. It's like buying shares of stock and or shorting shares of stock, not buying shares of stock. It'd be like hard borrow and shorting a company. That's basically what we were doing. And that's been working most of the year, but the market's starting to go sideways now. So the strategy is not quite playing out the way that it had in the earlier part of the year. But the argument to be made is, are these good strikes? Should we change the strikes and maybe get closer to the money, or back away and maybe even go just a little deeper in the money, widen them out? We were using very small trades about $5 wide. We can come in and we can look at the trade log and see, oh yeah, they're $5 wide. We're keeping them pretty tight. And see now this right here, we have an error here where it shows that we had a credit of 0 and a debit of 0. And then, we paid commissions and there was nothing. Why was there nothing? Well, the trade tried to trade both sides at the same time. It tried to go long the 35 and short the 35 because we don't have a wide enough delta between the 60 and the 62 on that particular day. So the machine wasn't smart enough to recognize that, hey, this isn't going to work. You shouldn't put that trade in. So one of the things that we can do to make sure that this doesn't happen is add perhaps a minimum value, right? So in the back tester, if we go back in here, hit the button, drag it down, there was a spot that says use a minimum value, right? And we're on the debit side. So if we want to avoid that kind of situation, we just make it a penny. You know what I mean? Like it doesn't need to be something extreme. We just want to eliminate that little credit trade right there. Aha. So we knocked that out of the way and it just helped realign things a little bit, right? So take the time when you're doing these tests to actually go in and look the trades over. One thing that always bothers me when I run these back tests is how many entire lots they're using. They're using 7 lot, 8 lot, 10 lot, right? I mean, I don't want to put on 10 of these things. The SPX is a massive monster anyways. So that's usually why I keep my starting capital backed off a little bit. But it wouldn't matter if we had starting capital, 100,000 or a million, or if this thing says that we should be doing these in 7 lots or 20 lots, it doesn't matter, right? We're just trying to evaluate our profit percentages, when to put the trade on. Can we trade without stops? We're looking for validation in our trade logic. And I like the results here. Let's look at some of the numbers. When we put this trade on, for an example, at the time of the trade, when it was opened, the market was at 47.90. And when the trade was closed, we were at 47.35. Okay. I mean, not hard to figure out, like, yeah, that was a darn good trade. 47.86 to 47.25. Again, really great trade. This is where it starts to slack off, however, when you get into the later part of May, June through July, because we've really been kind of bottoming out and not really getting continuously new lower lows, right? And so that's where a lot of these losers started to show up, right? Because we had 112 trades in total and 81 of those were winners. So I'm almost positive that the losers we're seeing in this strategy are from the last few weeks. All right, so now from here, what else would we want to adjust on this strategy to kind of validate what else we're doing? Well, let's look at the premium that was spent. These vertical spreads were $5 wide, and we were filling them for around $2.75. That's not too bad. That's a typical one. Generally, it's one leg in, one leg out, and would get around 250 for 250. Here, we're in the money. You could almost expect to get a better price. So let's go build one and see what it looks like if we build a 60-62 vertical, long put vertical, and just see what it costs us. $2.90. And this is what I'm looking at. Here's my delta. Follow that delta down, 60-62. That gets us 38.75 and 38.80. And it's pretty expensive. And that's typical. I mean, that's a pretty common, pretty normal way that a in the money long vertical would price. Now, one thing that we could do is try to limit this. I think if you push it too hard, trying to get something like 250, you may not fill, but it's worth a try to go back in and adjust the settings and see, could we get some that was priced at, say, 250, that we would not pay more than 250. Well, let's try it. I think we're going to end up with nothing, but let's see. 4 trades, 4 winners. Well, how about that? So by being very picky on the amount of debit we spend at that level, it really seemed to improve the trade outcome considerably, right? Because all we did is became more strict about how much we were willing to pay to get that trade. And I've kind of had this discussion before where I've talked about fair prices. All right, now obviously this isn't even fair price. This is just awesome price. But it considerably improved the results of our outcome by being much more strict about the trades that we took, looking at it and saying, well, I don't want to pay too much for the trade. So now that we know that this is beneficial, let's reduce the restriction a little bit, knock it down to, say, let's try 275, right? That's going to be a little less strict, a little more sloppy, and kind of see what outcome we'll get there. Okay, so we did get some losers there. Oh wow, Lucian just posted that that Al Brooks has officially confirmed that he's coming into the Bullish Bears on July 14th. So this Friday, I think. What's the 14th? Orale, I'm missing my numbers. That's Thursday. So Al Brooks will be here Thursday, guys. And that's pretty cool. 4 p.m. on Thursday. Well, I got to quit saying Friday. I'm going to get everybody all screwed up. So I think 75 cents is too lax. Let's go back in and kind of knock it down a little bit. Let's try 65 cents. Because 4 trades and 4 winners is fine, but I'd really like more than 4 trades, right? And one way that we can get more trades is if we are a little more lenient on how much we're willing to pay for the trade. So here we had 24 trades, 21 winners, and I mean, yeah, the max win's a little bigger than the max loss. The average loser definitely was bigger than the average winner. But no, I like these stats, right? And they're still 7-day stats. We're getting out within 4 days. I like that. And I mean, this is looking really good. I want to try to bump it a little bit more. Let's see what we can, if we just, this is 65%, or excuse me, 65 cents, 265. So let's just knock it back a little more and knock it down to, say, 260. Whoa, that did not function the way I thought it would. And again, for those of you who are kind of newer to what I'm doing here, maybe you're newer to options and you're thinking, what the hell are you adjusting? Okay, well, here's the trade basically that we're putting on: a 60-62 vertical spread. And the one that I just built, for an example, is pricing at $2.95. It's $5 wide. And if I spend $3 to open it, then the most money I could make is $2. But if I could open it cheaper than $3, the amount of money that I could make on the other side goes up a lot more. So it's like a little bit of a pendulum. If we take something off of one side, it goes to the other, right? Or I always kind of try to think of it like a fulcrum point or a teeter-totter. or the old school weights and scales. We're taking something off of one side and we're putting it on the other side. And the two things that we have to work with is risk and reward, debit, credit, profit, loss. They're the same things, the names change, but the thing is the same. So we're taking something off of one side and stacking it on the other. If the original trade is 295 and we want to try to make things a little more fair, then getting it filled at a cheaper price would balance those scales a little more. And that's the number that we've been adjusting, trying to knock it down cheaper and cheaper. 250 is normally what you would get if you built it, say, at the money. That's normally where you would see like 250. So you're risking 250 to make 250. All right, so let's come back out to the analysis tab. I had adjusted it a little bit more. We're at 60% here. We had one losing trade and the rest were winners. We don't have as many winners as we did earlier, right? So we've got less wins or less trades total, but still better than 4 trades. So 17 trades in total, 16 winners. Better wins than loss on the max win, max loss. This is looking really good. And remember that our criteria for taking this trade was based on nothing. It wasn't support, resistance, momentum, and trend, inertia, nothing. It was like, well, it's 9:45, time to go put my trade on. So what's the takeaway here? Well, one, as long as we remain bearish, you could just go in and put these kind of trades on. Okay. I don't really like the argument, but yeah. The other side of the argument is, suppose you did want to go short today, right? I mean, the S&P is kind of falling off the cliff this afternoon. Suppose you were looking at this and you thought, yeah, man, let's go to the short side. And you go and you put on a trade. What strikes and expiration would you want? And how much would you be focused on for the amount of money that you would spend? If you could fill the trade for 260 or less, then that would be a reasonably decent trade to put on. So one thing that got me thinking is, those days where we're kind of pumping to the upside in this bear market, one of those kind of days, if you was to go in and set a good till cancel order using 60 and 62 delta with 260 in debit, and you just set it on the machine, if you get filled, hoorah, awesome, right? Great, no problem. And if you don't, oh well, you didn't want it anyways because you didn't get filled at a price that you already know would offer you a better advantage, right? They talk in the options market all the time about edge. What's your edge? In this trade, the edge is we know what a fair price is or what a good price for our vertical would be. We don't want to pay more than 260 for that spread. And we know that if we do pay more than 260, well, you saw the results. Your chances of winning went down drastically. And the amount of money that you would lose when you're wrong went up. So we not only learned a little bit about what we want for a fair price, we also learned that this deep in the money vertical spread, long vertical, is a good strategy to use. Now we can check the dates and like put it on the call side and try to run it in previous years and see what that would look like. But I kind of like the outcome of what we got here, of what we learned here too. The idea that we now know what a fair price is, right? So it's pretty cool. This would be a good spot if you guys have questions about what we've been doing. Because one feedback that I got from these back testing days is that it seems to only be useful for people who already understand options. And I kind of understand that argument. And I appreciate the feedback, even if I don't necessarily agree with it. But I would argue that this is just as useful for someone who might not really understand options that well, because it's going to help you understand options better, right? A lot of times I like to learn things by just putting my hands on it, right? Grabbing a hold of something and turning it over and over and pushing buttons and see what happens kind of thing. So when it comes to options, I wish I'd had something like this when I was newer, just to kind of ask those what if questions. Instead, I had to learn how to use the analysis tab, which I mean is fine. That gets it done too, but this is way more accurate than that. I don't see any news that would have caused this. I mean, there was some central bank second quarter GDP growth. You know what? That probably did it. Yeah. Sure enough, 2 o'clock. French Central Bank Business Climate Survey, and then French Central Bank expectations of quarter-over-quarter GDP growth. That's all I see on there. I don't know what else would have caused it, but the VIX woke up and the bonds, while the dollar's moving around. See that pretty nice run up in the VIX, and the dollar had already started that breakover from earlier, but it kind of picked up speed. Got the S&P, the NASDAQ, and oil and Bitcoin all headed to the downside. Surprisingly, gold kind of came up a little bit with bonds. Bonds, gold, and dollar moving up. That weird stuff going on out there, man. Yeah, you're right. Hey, you're right. That ain't the way it's supposed to work. It's all right. So no questions, huh? You guys keeping up with this stuff pretty cool. Now, I didn't want to make it complex, right? Because complex stuff really doesn't solve anything. Now, I had someone asking about a small account the other day. And since I got done really fast, and since none of you seem to have any questions, how about we change the symbol and we try this on SPY rather than the SPX, and we make this account much smaller. All right, well, that certainly adjusted things. So one of the things that I recommend is to call timeout. When we change something and now everything is radically different, stop right there, go look at the trade log, try to get an idea for what this thing is trading. Because without that, we're going to have a hard time trying to identify what we need to fix. One thing that I would point out that we need to fix is the maximum entry premium. Let's just take that completely off the table for the moment, because we want to know what normal trades would look like, right? So let's get that off of the table. All right, so we're seeing trades anywhere between $1.11. And there's another $1.11 there. Well, there's a note that I haven't seen before, but I think is pretty cool. This would have exercised your position. Okay. I hadn't seen that before because I always backtest on the SPX, and you can't be assigned something that doesn't have shares to assign you. But here, you know, SPY actually has shares and it's giving you an exercise warning. Dude, that's cool. I did not know it would do that. So what I'm seeing is when the trade was $2 wide, it's a debit of over $1. And when it was $1 wide, it was below 60 cents most of the time. So, okay, I mean, that's not too bad. We can work with this. So one of the things, wow, 39 cents. That is awesome. That is really cheap. One of the things that I would recommend is that we try to keep it below, say, let's try 50 cents. Let's go extreme with it first. All right, well, there's our 4 trades again. All winners, by the way. So again, kind of validating that logic that we talked about earlier. If you pay too much for these trades, you're seriously handicapping your win rate and your profit, all of that. So 50 cents was a little too tight. Let's try 55 cents. Wow, that nickel, just that 5 cents was a drastic game changer, because now we have 42 trades. 12 losers, yes, but 42 trades. And we didn't really make any money. We started out with 10,000, we ended with 11,000. So we made $1,000. Yeah. Okay, well, I mean, let's, these are small trades, right? So let's kind of look it over and see what we've got going on here. The closing cost went to 0 on a few of these, so we were max loss trades. Interestingly enough, oh yeah, there's 3 of them. I was about to say the P&L is wrong, but no, we had 3 of them on. And so, max loss, 3 trades. Yeah. And commissions. Oh yeah, we got to knock the commissions back. So that's another thing we need to do when we go back into the tester. Commissions on the SPX are much greater than on the SPY. And that's because it's owned by the CBOE. And they're like, hey, that's ours. And you're going to pay us more for commissions if you want to trade it. Isn't that nice of them? Huh? I mean, isn't that great? They don't want people to play with their toys, I guess. All right. So let's go do that. Let's adjust the commissions. We're going to use old school Thinkorswim logic, which was around $1 to get in and $1 to get out. Well, I mean, it didn't really help too much, but okay. Let's go out onto the options chain. Look at this from a real world perspective. Where is a 60 delta on a 7 days to expiration option in SPY? Now I'm on a 6-day, not on a 7-day, so we're going to be a little off, but not by too much, I think. A 60 and a 63, we're barely in the money. I mean, we're not very deep in the money at all. And I kind of had that suspicion because the debit was so small, right? It was almost a 50-50. So one thing I would recommend is that we actually go a little deeper in the money if we're going to be on SPY. In the SPX, a 60 delta, I mean, we were pretty deep in the money, but here we're like 4 strikes. That's barely in the money at all. So let's make an adjustment there. We go back in, push the buttons. We're going to take it up to, let's go to 70 and 68. Watch me really break it. Yeah, okay. The reason that we didn't get any trades is because of the maximum again. So let's just knock that off. See what an average trade is filling for, and then we'll kind of get a feel for what we think is a fair price. 76 trades, 55 winners. We actually made 12,000, or I should say we made 2,000 now instead of 1,000. But those losers were big. They hurt pretty bad. And we still need some adjustments here. Still, it's not bad. Average cost of these trades, we're seeing 60s and 50s. And when they were more than $1 wide, then they were like $1.60, $1.50. Man, that Bitcoin is taking off to the downside, way worse than the rest of the market. Wow. All right. Missing out on some good stuff. What do you want to do? Say we knock it down. Let's go back in, put that maximum entry back on. And let's try 62 cents. Again, we're just trying to validate how much money is too much money. If we go to buy one of these, wow, that's pretty close. So we're staying in until almost the last day. We had 21 winners out of 24, so at 87.5% win rate. We still didn't really increase that capital much more than the earlier trade that we were looking at, so about $2,300. But remember how small these trades are. They're 59 cents, 61 cents. So, I mean, that's looking pretty good. And so one thing of note that I'm kind of catching on here is it's running in multiple lots. And with that multiple lots, it's adding all of those trades together for our closing cost profit, right? Because if this is a $1 wide trade and we opened it up with 60 cents of debit, then our max profit is 40 cents. But if you take 40 times 3, you get 120. And this is closing us down at 103. So it's closing us a little early, right? We get our money, and it's saying, hey, you would have been exercised here and you would have been exercised here. So we need to go in and adjust that, right? We look at all those exercises. And the warning was clear because we were staying in at 7.1 and it was only a 7-day to expiration trade. So let's definitely go in and make an adjustment there. Knock that target profit down. Let's try 65%. Days in trade down to 6.6. The amount of money we made would be smaller, but our wins were the same. And we're still seeing some exercise because we would need to manually close these down, right? There's no way we would just sit in these things and let them go into expiration in the money. No. But I do like this outcome here. I like how this helped me explain that how much you spend to open up a trade is really important. This is why a lot of times when people say, hey, are you trading, oh, I don't know, Tesla, Facebook, whatever. And I say, no, I kind of looked around, but I didn't see anything I liked. This is usually what I'm referring to. I didn't see a price that I liked. I built a couple spreads and none of them showed me a value that really interested me. And I just didn't take the trade. And what most people is thinking is, oh man, that chart looked so good. How come you didn't trade it? I didn't see a spread that I liked, or I didn't see an options position that I liked. This really highlights that, right? If you are paying too much for your trade, your outcome is very likely going to get handicapped worse and worse and worse as time goes by, right? So it's really important that you get a fair price when you open your trade. Now, what fair is kind of hard to negotiate, right? Which is where something like this backtester really comes in. This is where the real value of having a product like this comes to help you in a game-changing situation. Right. Earlier today, I had posted in the chat my midday lunchtime analysis. Let's go in and review this a little bit, kind of understand what's happening in our lunchtime here and how you could have prepared for this opportunity. Bum, bum, bum. This is the lunchtime review for today. After a choppy morning and a rough start, the SPX has stabilized and printed higher highs and higher lows consistently since 10:30. This ties into an advancing financial sector and an improving tech sector. The weighted AD is positive and expanding nicely, adding more conviction for an afternoon that sticks with a single bias into the close. There is a 52-week bill auction at 11:30 and a 10-year auction at 1 o'clock. So be mindful of the likely impact the 1 p.m. auction will have today. Here was the picture at the time. Consistently higher highs and higher lows. And we had just got back above yesterday's close. We had gotten past today's open and broke out of the 5-minute open range to the upside. This was the expanding AD that I had referenced. Mentioned the weighted AD above shows improving sectors and increasing strength. And then the advanced decline down here, while it had more advancing than declining issues, it still wasn't even at a 50%. Same thing with the NASDAQ, more advancing than declining. But if you take advance minus decline, we were still pretty weak. And I pointed that out. The C ticks were pointed pretty sharply to the upside, and they had just started to really roll over for lunch. And then a look at technology, just retesting the VWAP right there in the picture, and financials, which were expanding farther away from the VWAP at the time. Then we get into the now what for the afternoon conditions. If we were going to turn bullish, which we don't even need to read through now because we didn't go bullish, we went bearish. So let's just focus on the if we turn bearish part. After the 1 o'clock auction, we want to see the weighted AD drop below 0 and expand quickly into the -150, -250 area. We want to see the advanced decline line drop to 0 and maybe even cross sharply lower with conviction. We want to see the C-tick green line break sharply lower, cross through the NASDAQ cumulative tick, and lead the entire group of cumulative ticks lower. And then we want to see the actual tick get below 0 and stay there with a minimum crossing back above 0, and also preferably with a few pushes somewhere between the 850 and 900 range would be a good sign of continued strong moves lower. We would want to see the financials and tech sectors give up on any strength. The KRE would need to break back inside the previous day's range and perhaps all the way back through the VWAP. Tech sector would need to retest the regular trading hours low and perhaps begin expanding into the new low of days zone. Let's take a look at what we have right now and see how much of that hit the mark. Here's our advanced decline line below 0 and pointed sharply lower. Strength and conviction. Here is the cumulative tick with the green line, which broke sharply through its peers. Come on, do your job. There you go. It broke through its peers. It's not leading the way lower, so I was a little off my mark there, but we are back below the 0. We're pointed sharply lower, and all of them are moving in that direction. Here are the ticks firmly in the negative, a couple of extremes below 1,000. We've had 1 or 2 crossovers, sure, but for most of the afternoon, predominantly in the red, with some good solid negative ticks down there. And when we bring in the weighted AD, a significant crossover below the 0 line, pushing well below my 250 target, demonstrating absolute conviction in this move lower. There was no doubt, no hesitation. And if you scroll back and read the entirety of my little afternoon lunchtime thing, it said the main thing we want to focus on is that we didn't want this wishy-washy sideways kind of bleh. We don't want that. We wanted clear, clean, convincing signals, solid flow, very deep structure, and all of these things lining up, including the XLF, KRE, and the XLK, breaking sharply lower than the previous day's low with conviction, heading to the downside. All right, so that's our back test an in the money long vertical, and recognizing fair price for an increased win rate and a better outcome. If you guys don't got any questions, we'll just wrap it up there and call it a day. All right, well, thanks for your time, guys. Don't forget, this Thursday, Al Brooks is going to be in the Discord, going to be presenting a webinar. And I've got a webinar coming up on August 3rd with Whale Stream, planned for 1 o'clock in the afternoon as well. That's going to be pretty exciting. And that's it. Y'all have a good one. If you're doing some tests on that OptionOmega and you come across some pretty good results, hey, share them out, right? Share them with us. Let's we'll kick them around and take a look at them and see what you got. It'd be pretty cool. Be careful, everybody. Have a good night.